Good afternoon, traders and investors. Will back here with another one, coming to you with a Sunday video, guys. And it's that time of the week again where we go over the top 5 options plays for the upcoming week. Hopefully all of you had a very nice weekend so far. Now, in terms of the options plays, they are all going to be for selling options, more specifically for selling put options as part of the larger wheel strategy that I like to run on the channel. This is the same strategy that you saw me guys run in 2023 when we made 75% ROI. In 2024, we made 65% ROI. And overall, it's just a very easy strategy to run, whether you're a beginner, intermediate, or even advanced investor. It's very consistent. It is somewhat risk averse as well. It requires low time management and overall just very easy to understand. So in today's video, guys, we have a few things to take care of. Number one, we're going to look at the expectations for the week. Do we have any big earnings or any big macroeconomic events to take a look at in terms of what could possibly affect the markets? We know that recently in the markets, it's been extremely volatile with the new Trump administration policies, namely the tariffs, of course, and we just seek to see if there's anything else noteworthy on the horizon for this week, and also do a little bit of technical analysis to see whether or not after pretty much 2.5 weeks of straight downshot, could we be approaching a local bottom and due for a little bit of a bounce this week. Thereafter, we're going to present these strategy rules. I'll be going over these strategy rules, which allows me to find the best put options to write on a weekly basis. We're going to be doing a very brief recap of those rules. And then, of course, lastly, dive into the top 5 options plays. And as per usual, I do have a lot of bonus plays for you guys, so make sure you stick around to the end. So without further ado, let's get right into the action. So in terms of the expectation for the week, well, we know, guys, that Wednesday is going to be the biggest day, of course. We have CPI. Now, watch out. Because of the new tariffs and the volatility that they've brought to the markets, considering the fact that tariffs may just be the one thing that reignites inflation over the next 3 to 6 months. It takes a while for the tariffs to be priced into the economy and make their way in affecting consumers' pockets, that's for sure. But when there's an inflation concern, if we get a CPI read that even comes in slightly hotter than expected, the expectation is 2.9 for the week. If this comes in at a 3 or core comes in at a 3.3, 3.4, expect the markets to not like it too much and go heavily to the downside. That is the biggest news report for the week overall. Other than that, it should be relatively smooth sailing in terms of data releases, but keep in mind, any tweets from the new Trump administration or any one of his press conferences where he talks about the economic instability or stability of the current tenure, well, that is obviously going to affect the markets as well. So we need to proceed this week with caution, and you will see me proceed with caution in pretty much all of the weeks moving forward, the next 2, 3, 4, 5, 6, 7, 8 weeks, guys, as we move into these new policies and the markets adjust in tandem as well. So we're going to change up the wheel strategy ever so slightly and only look for the best quality companies in the market in daily oversold conditions. Keep in mind, talking about oversold conditions, fear and greed index is at extreme fear reads. Market momentum is extreme fear. Stock price strength in terms of net new highs and lows on the New York Stock Exchange, that is also extreme fear. Stock price breadth, how many names are going up versus down, how many sectors are going down, well, that is extreme fear as well. You can see this damage pretty much done on the 1 week performance, on the 1 month performance, all aspects of the market arguably getting hit equally. However, we are coming into a period of somewhat bullish seasonality as displayed by this chart. Late February into early March, usually you do get some declines, and that's pretty much matched up exactly with the time period that has just passed us. Could we maybe be seeing a little bit of a rally into the end of March? Quite possibly, guys. And when you line that up with some daily almost oversold conditions on the SPY, 2.5 weeks of a straight shot to the downside into the 200 EMA, into support, you could get a recipe where, yes, we are expecting maybe a little bit of a bounce early on in the week and just a little bit of a retracement to the upside for the bulls. Now, of course, after that retracement, we can simply roll over, but if we get a nice entry opportunity on the Monday, maybe it allows us to write some contracts on Monday and maybe even get out by the Tuesday afternoon if the markets are bullish before CPI. So that being said, those are your expectations for the week. I still do like bidding these markets at these levels at support at relatively very weak RSI levels after pretty much 2 massive legs to the downside, the weekly timeframes as well, into the 50 EMA, into our big support on the SPY, and similar to the QQQs as well, into support, into the 50 EMA on the weekly, into the 200 daily EMA on the daily time frame, and somewhat oversold as well. All those things combined can lead to a recipe where we see a short-term bounce. So I do still believe it's a good opportunity to go shopping and run the wheel strategy, but we have to be a lot more selective with our companies, guys. only the highest quality companies that you can possibly find, and also line it up with daily oversold conditions. You will see that all the stocks I will present to you on this list this week will respect those two criteria. They are all very high quality names for the most part. And number two, they are all within daily oversold conditions. So that being said, that is your presentation for the weekly expectations. In terms of earnings, well, it's kind of a light week. We have a big one on Monday after the close. Oracle is going to be big for all the SaaS plays. But other than that, guys, I mean, we have Adobe on the Wednesday session. This is true. A few cybersecurity names here and there, but I'm not going to be playing any cybersecurity names this week. And none of the plays on my list are really tied into the SaaS market either. So overall, even though there's a ton of earnings, nothing that can truly move the market in a huge way, such as we saw with either big tech or the Walmart earnings or other very large companies such as Costco last week too, right? So that's our presentation. Now let's dive into the strategy rules. So before I get into the rules, guys, I have a 30-minute video down in the description where I go over a lot of these rules way more in detail. I will also leave a second video in the description where I used to do these every Sunday video. I used to spend like 10, 12 minutes on these rules. So I'll link to the shortened format of that as well, because in this video currently, I'm going to really fly through them. That way we can get into the plays right away. So in terms of the put wheel, what exactly is writing puts to open, AKA selling puts into the market, right? You can just think of it very simply as a buy limit order that pays you. Let me explain. Let's say you want to buy Google stock after their 20% decline into this very beautiful support level. There's two ways you can do it. You can set a buy limit order under the market for 100 shares. Everybody knows that. But unfortunately, if it doesn't fill and the market just pulls away, you don't get the shares and you also don't get paid. That is where short puts come into play. If I'm looking to buy Google, let's say in or around the expected move this week, which is like 167.5, well, I can go on the options chain, sell a 167.5 put and get $90 in compensation. If Google stays above that price level by Friday, I just get to collect the entire $90. If Google falls below 167.5, well, I still get to keep the $90, but then I add that to my average cost. It gives me a discount of roughly 89.90 cents per share, or $90 in total for the position. So that is the presentation for what exactly short puts are. Now let me get into the rules as to how I find the best possible contracts and how we can avoid some assignments and how we can avoid also some losses too. So number one, we want to be building a watch list and filter for red. You guys see me show this options list all the time. I put my favorite companies, ones that I'm looking to run the wheel strategy, on an options list, and I always filter by red. I'm not in the business of chasing the market to the upside. I want to be buying stocks when they're coming down into big support levels. So the first thing I do Monday, Tuesday morning is filter this list by percentage change, and I'm only interested in the ones that are red on the day. Number one, it has to be a very high quality, high conviction company. I think all you guys, after the last 2-3 weeks of declines, now you guys know why it's important to go for high quality, high conviction companies. Because if you get trapped on a stock that you don't have high conviction on and the losses start mounting, you start wondering what the hell you're doing in the position in the first place. So keep it, especially in this market environment, keep it to high quality companies only, guys. I don't want to see you guys start playing some of these growth stocks with not much revenues with crazy high price to earnings ratios, okay? High quality, high conviction companies only. Number two, companies have to be in a monthly uptrend or a long-term range. This means the bulls, the long-term bulls, are at our backs. Even in correction times, they're going to come to kind of support some price levels better than not. Number three, no earnings this week. You guys have seen how volatile earnings have been over the last few quarters. Just do not do it, guys. It's not worth the risk, in my humble opinion. If you see a company has earnings this week, you will look at the options chain and you will see some fantastic premiums. Do not get seduced by the market makers. Do not do it, guys. You guys know a stock can have good earnings and still go down 10, 15, 20%. If you want to avoid any massive losses, do not write any put options on stocks that have earnings this week. Number four, we want to be targeting companies that are in weekly support areas, such as Google that I just showed you, or an area of breakout retest. What does an area of breakout retest look like? Well, quite simply, it could be something like a BlackRock on a monthly time frame, right? breakout, retest of a prior range of resistance, which is now support, and then run. This is also known as the trend continuation trade. So every one of the trades I'll show you is either going to be a trade like Google, where it's literally in to a large support area, or it's a breakout retest trade. Those are the highest probability trades for upside follow through. Now, moving on to the next rules here, we want to be writing at or lower than the expected move, and in combination, writing on a red or flat day. What is the expected move for a stock? You can go on this website right here, barchart.com. Just type it into Google, barchart.com, expected move, and then the name of the stock you're looking for. You will come to this page right here. You can see I have Google pulled up. The expected move for the week is 169.97. We want to be writing below the expected move. Why? Because it increases our odds of not being assigned. If the market pulls back heavily early in the week towards the expected move, we can then write some strikes even further below the expected move. And usually when that happens, the market tends to revert back within the confines of these expected moves throughout the week. So that is what we want to target. And obviously, we want to be writing on a red or flat day because obviously, guys, if we're looking to write below the expected move to the downside, if a stock just blasts off to the upside, well, we're not going to be able to find any premium down there. That's why we want to be looking for stocks that are red on the day. Now, before last, we want to be writing 0.5% to 0.75% in weekly premium. This is your take home pay. This is the ROI. If you're always getting between 0.5% and 0.75% per week, every single week throughout the year on your capital, that means you're going to be making between 26 and 35% annualized. That is a very good return, guys. That is almost 2.5 to 3x the annualized return of the S&P 500. You can even be a little bit more conservative than this, but this is the sweet spot. After running the strategy for the last 6-7 years at this point, this is the sweet spot that I've derived where, number one, you're giving very good ROI, all things considered, but number two, the risk of assignment is fairly low. Usually you're going to win 95% of these trades. Some people like to use Delta. I don't like to use Delta because the Delta is going to be different whether you're trading Coca-Cola, MSTR, or Google. However, the 0.5% rule encompasses all the variations of implied volatility depending on the options chain. And the rule is as follows. Just divide the strike price by 2 in your head, and that is what you're looking for on the bid. So half of 167.5 is roughly 85. So you know that you need to be looking at least for 85 cents on the bid. It's a very easy rule to follow in your head, guys, right? You can do the math very quickly and go through a ton of options chains really fast. That being said, I'll repeat it again. You want to look for 0.5% of the strike price. If you want to do this with a calculator, just do 0.005 times your strike price as well, right? And that's going to be roughly 85 cents. But just quick mental math, divide the strike price by 2 in your head, and that's the amount of cents you're looking for on the bid. It's really easy to remember. And lastly, you want to set a take profit order at 90% of the contract's value. If you get into Google this one for 89 cents, you set a take profit order for roughly 9-10 cents. It makes sure that if Google rallies early on in the week, well, at least you're out of the trade, you got your capital back, and you could go shopping for another play. This is just to be very capital efficient, right? Now, if you are assigned the shares, if you have to buy the shares, we're going to be writing covered calls. You want to be writing covered calls between 0.5% and 1% in weekly premium, same as we did with the put options. But if you're assigned, you want to look for 0.5% on the call side, right? Getting into a stock is using short puts. This is a buy limit order under the market. If you end up buying the shares, you want to get out of the trade, you're going to set a sell limit order by selling a call option against the position, looking for similar ROI as we did on the put side. And lastly, you're going to be writing those covered calls at the assigned strike price or 1 strike higher if you can find decent ROI, and that respects your minimums going 1 strike higher, right? Those are the strategy rules. Very, very briefly, guys. As I said, 2 videos in the description if you want a longer, more detailed explanation on that. Now, let's get into the juicy stuff, which is going to be the plays. So plays number 1 and 2 combined, these are going to be very, very, very safe plays. Let me just remove this real quick. Number 1 is going to be SPLG. What is SPLG? Very simple, guys. It's literally the S&P 500. It's an ETF of the S&P 500. It's the same thing, except for the share price is a lot less than the S&P 500. So this one is, you're able to do it with a smaller account. That being said, the reason I like it, well, number 1, it's the S&P 500, and we're targeting a very large area of weekly support, 67.5 down to 65 roughly, which is a sell-off on the S&P of roughly 7 all the way down to about 9%. You want to be buying some shares of the S&P when it's into that type of correction territory, especially since we're very close to over oversold conditions right around the 200 EMA into big weekly support. That is what I like to call confluence, because you might just be getting a little bit of a bounce. That being said, the expected move for the week overall on SPLG, well, it's not a weekly contract. This is the drawback. It's a 2-week contract. The expected move for the next 2 weeks, March 21st expiry, is 65.79. So let's go shopping and see, can we find any good premium on SPLG below that strike price or around that strike price of $66.65. As you can see on the options chain right here, March 21st expiry in 2 weeks. If we're looking for 0.5% per week, right, that should be roughly 33 cents. Times 2, because there's 2 weeks, you're looking for 1%. So you're going to be looking for about 60 cents roughly, right? Now, unfortunately for us, there's nothing at 65, right? It's a bit light on the premium. However, one that I do like, even though it's slightly under the expected ROI, that's fine. The $66 strike right here is paying roughly 55 cents. I would not mind that at all. It's very close to the expected move. It's not below it, but I would not mind writing a $66 strike on the SPY. Why? Because you're getting 55 cents in premium, meaning your average cost on the trade will be all the way down here in the 65.45 zone. And with an average cost like that, you'd be looking at a top to bottom drop of 9.2%, guys, right? I would not be opposed to buying the S&P 500 at a 9.2% drop from the all-time highs. It does not happen very often, so when it does, we want to capitalize on that trade. So that is the trade that I'd be looking for SPLG come the Monday session, $66 strike for March 21st. Now, stock number 2 also, this is part of plays number 1 because they're equally very solid. This one is not the S&P, but it's a play with a 2-week time horizon. This one is Brookfield. You may know about this company, you may not. It's an investment manager similar to Berkshire. The reason I like this one, the trade set up technical pattern, breakout, retest of a prior 2021 all-time high. This time as support, the stock is now down roughly right to the lows of Friday, was down almost 20%. Plus the fact that we are now into daily oversold conditions and reacting from our beautiful support zone, which starts at $50 down to about 45 bucks. This is why I like this trade. I would not mind picking up shares of Brookfield. It's a very well diversified company overall, and the management team is absolutely fantastic. That being said, the expected move for the next 2 weeks is 49.02. I have this one in my own portfolio, guys, with a $50 strike. All right, so I went a little bit higher, but let me go shopping for you guys as well in the event that some of you wanted to participate in this somewhat defensive and value-oriented trade overall. You can see here that for the next 2 weeks, $50 strike, you're getting 75 cents in premium. This is my strike. Last Friday, I literally picked the lows. I got $1.20, but even here, the ROI is not bad, right? 0.5% times 2 would be 1%. 1% of 50, well, you're going to be looking for 50 cents on the bid. As you can see, there is well over 50 cents on this bid right here. Even now, 75, 80 cents, very decent proposition. Why? Even though the expected move is 49, if you're writing a 50 strike with a 70-cent credit, your average cost would be 49.30 roughly. That would be a sell-off top to bottom of 21% on Brookfield, would be indeed into daily oversold conditions, and would also be into this massive level of monthly support as well, which is where I would not mind building a position in such a fantastic company. So those are plays number 1, SPLG and Brookfield, more value and defense oriented. Number 2 is going to be a growth play because I had to include one, and it's a lot of a retail favorite right now is, of course, SoFi. So SoFi has come down a lot from the top to bottom move right now. 35% to the move on Friday. The reason I like SoFi, a few key reasons right here. Number 1, we are approaching daily oversold conditions. We are not there yet. Reacting from the 200 daily moving average as well. It's a 35% top to bottom decline, and we're coming into the next closest available area of support, the IPO price, the resistance from earlier here, 2023 and 2024, and all of your monthly moving averages are sitting there as well. This zone is roughly 1170 down to about 950. It's a $2 range, but we want to be going as deep as possible into the range. And since SoFi has some pretty good implied volatility, we'll be able to get some pretty deep strikes in that area. I myself wrote the $11 put for next week at the lows of Friday, but even today, you're getting some fairly good premium. So the expected move for this Friday is 11.71. Let's go shopping on SoFi to see, can we find something below 11.71? As you can see right here, the contracts for next Friday, you are getting the 1150s at 15%, at 15 cents. That is over 1%. That is almost close to 1.5%. Now, if you might say that's a bit too aggressive for me, maybe 11.5 is a bit too close. We know SoFi can move a lot. That is only 9% away. I know 9% sounds like a lot, but you guys know these stocks. Sometimes they can move 7, 8, 9% in one single day. So if we want to be a little bit more risk averse, we'll look down here. You can get the $11 strike for about 8 to 10 cents. That is still roughly 1%, and that will be a steep decline on SoFi of roughly 12.57 for a single week. That would definitely bring them into daily oversold conditions, bring them into our large area of support, and is a great level to start a position on SoFi if we're looking to play this beautiful monthly breakout, retest of a range now of support, and maybe run later on when there's more clarity in the markets. That is why I still love playing SoFi at these lower levels. So that is trade number 2, a beautiful idea on a fantastic company whose valuation right now is pretty good. We did this valuation at 16. It's now down to 12. It's under a 1 peg, growing revenue and EPS fantastically. And it does have an average analyst price target right here of about 14. So there is some upside all the way up to back to this resistance range, which is roughly $14 to $16, right? Not a bad play, all things considered. Now, stocks number 3 is a pair of semiconductors. I know semiconductors have not been that favorable recently, but these we cannot ignore because of the valuation. Number 1, and I'll keep it very simple, I'm only going for the highest quality names in all of semiconductors as of right now. And name number 1 is NVIDIA. I like NVIDIA for a few reasons. Number 1, it's coming into a big area of support, which is roughly 114 down to 106. It's reacted nicely from the lows last week, and now we're possibly putting in a bit of a bounce. We are approaching daily oversold conditions, but we are not there yet, which means that any further declines might open up, guys, some fantastic strikes below 100. Look at the expected move for the week. It is 106.12. But with NVIDIA's volatility, we can probably get a lot better than the 106 strike. I'll be targeting between $100 and $90, all the way down here to the bottom end of the lower support range. If we come below 100, guys, that would be a top to bottom sell-off on NVIDIA of 34%. Now, the number 2 reason I like NVIDIA right now, at 115, the valuation is a 1.1 peg. This is the cheapest NVIDIA has been in a very long time. I know the share price is similar to what it was last August, but what they've done since then is improve EPS and free cash flow by a substantial margin. So I love playing it down there. Let's go shopping on the NVIDIA options chain and see how low can we possibly write some put premiums on NVIDIA to possibly pick up some shares of this fantastic company, right? So let me pull up NVIDIA. While it loads, let me take a quick sip of coffee. Wouldn't be a video without a sip of coffee, right? And look at this, right? I'll expand the chain. We're going to look for the 0.5% rule. Around $100, divide $100 by 2 in your head, it's 50. So you're going to be looking for the closest area that you can find 50 cents. Look what we have here. 100 or 99, that is $6 below the expected move. That would be from now to $100, a 12% downswing on NVIDIA. I would definitely like to do that if it comes there on the week, because if we have a 10-12% downswing on the week, NVIDIA is going to be deep oversold and starting to come into the lower area of support, which is exactly the criteria that I want. So I'm not playing this one too close. I will play it far away. So for me, this week is going to be the 100 to 99 strike. Now, on the Monday session, if NVIDIA drops 2-3% back down to roughly 110, 108, am I going to stay planted here at 99, 100? No, these premiums are going to move down. You might even get the 95 strike, the 94. The goal of this strategy is, depending on the size of the moves down on the Monday session, you're going to try to go as low as possible on this options chain while still getting your 0.5% in ROI premium. So for me this week, it strikes between 100 and 95, as low as we can possibly get. And we know this market, in the event NVIDIA somehow has a 5-6% negative day on Monday, comes all the way back down into like 104, 103, well then guys, it's going to free up the juiciest strikes ever, maybe even the $90 strike. So as low as you can go on this chain while trying to get deep into this support range, which will also be synonymous probably with daily oversold conditions. And NVIDIA has not had daily oversold conditions now, guys, In how long? Since September of 2023. So we have to be buying these dips, especially if you like NVIDIA as a company. Semiconductor trade number 2 is going to be another very high quality stock. It is going to be Taiwan Semiconductor. I like this one as well for 2 key reasons. Number 1, we just bounced out of daily oversold conditions. If you drop a little bit further, well, you're going to have daily oversold conditions again at number 2 into a massive area of support, guys. On TSM, this is the biggest area of support that is, very close to the stock right now. This is the monthly time frame. You're talking about 170 down to roughly 160. This 10-point range, which is the bottoming out process last fall, right? And now top to bottom declines on TSM of roughly 23.5% to the lows of Friday. The second reason I like this one, guys, well, not only does it have an absolutely clear monopoly status on what it does, well, you can argue whether it's a monopoly or not, but they are an industry leader. The competitive advantage is huge, and they have a very wide moat that is almost impossible to disrupt at this point. And look at the valuation here at 177. It is a 1.14 peg. So if I'm looking down here at 170 to 160, this peg would be very, very close to a 1 peg, which is absolutely fantastic for this long-term compounding company overall. Very predictable company in the grand scheme of its respective industry, which is semiconductors, which are not known to have predictable natures, but this one does. This is one of 2 only semiconductor plays that I have in my long-term portfolio that I've been holding since 2018. The fundamentals are fantastic. We cover their earnings. The demand is super strong, at least for the next 2 years. So that is TSM, the presentation. Let's go shopping to see, can we find some premium below the expected move, which for this week is 169.07. So let's take a look, shall we? As you can see right here, there's a few strikes, as a matter of fact, that are offering some very juicy premium, right? Half of 160 is roughly 80. So look where you're getting 80 cents on the bid. Well, it's at the 162.5s. That is significantly below the expected move of 169.07. That's the beautiful thing about a high VIX right now. You're able to get way, way, way below the expected moves. And if TSM drops on the Monday to start off the week down 2-3% into the lower 170s, well, guess what's going to happen? You're probably going to be able to get the 160s. Maybe you're even going to be able to get the 157.5s or the 155s, depending on the drop. Be dynamic with your strikes, right? Let the market come down and then you write even lower into daily oversold conditions, and you'll be able to pick up a fantastic company in the lower 160s, perhaps. That would be a sell-off top to bottom, if you do get it down there, of 29%. How could we be upset about buying TSM at a 30% decline off the all-time highs at a roughly 1 peg when they're growing this much over the next 2 years? Looking pretty good on that front. Those are the 2 only semiconductor trades that I'm looking for this entire week. I'm staying concentrated into the highest quality companies of their respective industries. Stock number 4 is going to be one that everybody knows. This is going to be Amazon. Amazon needs no introduction, guys. We covered their Q4. Their Q4 was fantastic. Not only was AWS growing, but all lines of business were equally growing as well. Their advertising business, their e-commerce business, their Prime Video business, their pharmaceutical business, which they're ramping, all aspects of the business are outperforming. They're growing EPS at a fantastic clip at 190 right now. It's about a 1.5 peg, which is relatively cheap for Amazon, all things considered. Free cash flow and gross margins are rising as well. The fundamentals of the business are fantastic. None of that has changed with the most recent sell-off. What has changed, though, is the price. From top to bottom at the lows of Friday, you're talking about a 20% sell-off. That is juicy. Below the 200 EMA, in the context of an expanding business cycle for Amazon, very rarely do you clip into the 200, and every time you do, it's usually synonymous with being a tremendous buying opportunity. Couple that with daily oversold conditions, number 1, and the fact that we're coming into a very nice area of weekly support, which is prior resistance, now going to be support. You have a recipe for a nice little bounce opportunity for this stock. So we may as well bid it while it's here in our grasp, pretty much, right? The expected move for the week is 191.90. Let's just call it 192. So let's go shopping on Amazon and see if we can find anything below the 192 strike. So let me just pull up Amazon right here. I don't have it up there. Give me a second. So Amazon below 192, yeah, that would be deep daily oversold conditions and roughly a pullback of 22% from the highs. That's not the right page. This is the right page. As you can see, we're looking for half of 190. Half of 190, guys, is 95 cents. Where can we find 95 cents? Well, look at this, guys, at the 187.5. So you're getting even well below, a couple dollars below the expected move, all the way down here, 187.5 is still open. That will be a top to bottom decline if assigned of 22%. Yes, please. I would not mind buying 100 shares of Amazon down there overall. And if you don't have the capital, you can always explore something like an AMZU. It's a 2 times leverage version, so you have to be a little bit cautious on this one. Go with a little bit more wiggle room, around the $30, maybe $29, $28 if you can find it. The contract size is only $3,000 instead of Amazon's big contract size, which is $18,000. I am also playing that one, the AMZU one, as a proxy too, but I like this trade on Amazon, and that for you guys is trade number 4. Trade number 5 is another big tech name which has sold off in equal parts, which is Google. Google is now down top to bottom, right, of about 15, 16%. At the lows, it was down almost 20%. Now we are coming into similar things, bouncing out of daily oversold conditions, but if we get another leg down, it will be once again daily oversold conditions. Couple that with the fact that we're coming into a very nice area of support, 175 down to about 165 as well. The valuation on Google as well is fantastic at this point. You are talking about at 180, it is a 1.35 peg with a forward price to earnings of 20. A forward price to earnings of 20, literally in line with the S&P 500 for a company that's growing faster, arguably, than the S&P 500. Fantastic net margins, fantastic cloud growth. YouTube business is dominating still at this current time. All lines of businesses are operating at full capacity overall. So I like playing the sell-off on Google. The expected move this week is 169.96. Let's call it 170. Let's go shopping on Google to see, can we find anything on Google? Well, if you remember from the introduction, absolutely you can. Look, you have the 167.5s. Half of 170 is 85. So you know that you're looking at the 167.5. You're getting enough premium on these. Now, if Google drops early on in the week, Monday or Tuesday, and you're patient enough, I mean, the 167.5s are free right away. However, if you get a red day on a Monday or a Tuesday and the stock comes back down 172, 171, 170, you're going to be able to get even better strikes, guys. Think the 165, maybe even the 162.50s, which would be fantastic. You would be picking up Google 20+% from the all-time highs. Not a bad bet in my opinion. And that is everything for our top 5 options plays for this week. Now let's dive into some bonus plays. Now, the bonus plays, it's not that they're not as good as the top 5. It's just that some of them are a little bit more volatile than the ones I just showed you. And number 2, some of them are just not ready yet. So I'll be giving you the bonus plays, but I won't be giving you the expected moves. I'll just be giving you the areas that I like them in. You guys, now that you're pros at this, you can go off and find the expected moves on your own and find the perfect strikes for you. Number 1 has to be e.l.f. Beauty. e.l.f. Beauty, I love this stock, guys. It is so cheap right now. Talking about a forward price to sales of 3.15. That is cheap. Forward price to earnings of 15.7 and a forward PEG ratio of 0.87. It's dirt cheap. You're buying this one where it was January of 2023, which is the closest support area. Anywhere between $65 and $50, guys. I'm a very big fan of playing e.l.f. Beauty. Fantastic company, very loyal customer base. And if you look at their growth in the future, growth is not a problem for them, right? Massive EPS expansion and massive revenue expansion as well. And they've also been on record saying tariffs are not a problem for them either, guys, at this point in time, right? They have so much pricing power. If they get hit with, because they source some products in China, if they get hit with 10, 20% tariffs from China, I mean, what are their products going to go for? Most of their products sell between $6 and $15. And it's on the cost basis, not on the final price is the tariff, right? So in the grand scheme of things, how much are their products going to increase in price from tariffs? 30 cents, 50 cents? Do you guys think people are going to stop buying e.l.f. Beauty, especially how viral of a brand it is? Do you think people are going to stop buying their lip gloss when it moves from $12 to $12.50? Probably not, right? So that's stock number 1, e.l.f. Beauty. Second one, of course, is, Pepsi. Pepsi, a more value-oriented play. I covered it yesterday when I did the weekly recap video and the top stocks I'm looking for. If we can find Pepsi 148 to 145, big fan of retesting this area of support. It pays a very healthy dividend and just an overall safer stock in the overall market turmoil environment. They also pay a very healthy dividend rate, 3.5%, and the stock is still down. Rather than chasing value names that have popped up too much, still down, if we come back there, 24%. Decent opportunity to go shopping for Pepsi, which is a long-term value and defensive stock overall. Fantastic brand. Stock number 3 is going to be UPS. UPS coming into a fantastic level of technical support. All the support here from 2014 through 2020. This is 6 years of price accumulation of support. We're now back into it. The stock pays a 5.5% dividend almost if you are assigned, and coming off out of daily oversold conditions from the earnings. So if we get a little bit of a retest down here, guys, I like 115 to 112. This little pocket right here, accumulating some shares of UPS, I would not be upset at all of being assigned in this massive area of support, especially knowing that there's a growth to value rotation underway right now. Another aspect of the market is possibly gold, right? You guys know that gold has been absolutely flying recently. One of them that's not been flying too much is Barrick Gold, one of the largest gold producers in the world, at a very nice area of support, 17.5 down to 15, guys. This is literally 4 years, almost 5 years worth of support with gold on a massive uptrend. If we get a little bit of a retest here, I would not mind being assigned some shares and playing the wheel on Barrick Gold. Once again, that is 17.5 down to 15, fantastic area of support, and a cheaper stock, and one of the ones that's a bit more defensive than the other ones. It pays a 2% dividend there as well. Another stock, a little bit of an expensive one, is Microsoft. I am wheeling this one myself. Microsoft needs no introduction. Fantastic company, still holding on to support, but you want to be a little bit greedy with your strikes. We know that this one from the all-time highs is currently down about 15%. So if we can find some premium down here, 380 to 370, fantastic pocket. That's the lower area of support overall. That would be a top to bottom decline on Microsoft of 20%. If we can't buy Microsoft, guys, at a decline of 20%, I don't know what we're doing here. This company is one of the most solid companies in the entire world. All the price targets are above with good reason. Their fundamentals are fantastic. Look at this EPS expansion. Look at the revenue expansion. Their balance sheet is one of the most solid balance sheets in the entire game. The company has like 35% net margins as well. It's been accumulating this entire time overall because the valuation, although not cheap right now, is fair for Microsoft. Microsoft usually always trades a little bit rich because it's such a high quality company. So picking it up down here, 380 to 370, even using MSFU as a proxy, right? I labeled 33 strike on MSFU, which is the 2 times leverage ETF on this one. You know, lower 30s on this one, guys, 3130, that would be Microsoft like 380, 375. Not a bad idea if you're looking to play it with a bit less capital and you're open to taking on a little bit more risk because it is a 2 times leverage ETF. Microsoft, in my opinion, is going to probably find a local bottom if it has not found it already. Thereafter, you have another cheap one, which is New Holdings. This was one that Warren Buffett was in, coming into a very nice area of support. The valuation on this one, we did it at $13 and it was cheap. At $11, it's even cheaper. And at $10, it's even cheaper. $10 down to $9. If you know this company, it is a Latin American play, fintech play, basically a digital bank in Latin America, very high growth. Even though the stock price is cheap, this is a $50 billion company overall, fantastic fundamentals, expanding revenue, expanding EPS, and expanding net margins. Nothing wrong with the company, just consolidating with the rest of the market. $10 to $9, I would not be opposed to playing this one as well. And then you have a few other ones that are key notes. Nike, if Nike somehow dips its toes back down into the 75 to 72 range, I will be playing it. This is literally how long, guys? 2018 prices. And I think Nike's turnaround story is starting right now. It's also viewed as more of a, not a growth play, but more of a value-oriented play. And you can see in the most recent weeks when the market's been selling off, what has Nike been doing? It's really been holding up its price quite nicely. So $75 to $72, if we can find some premium down there, I wouldn't be opposed to playing Nike down there. Same thing for NVO. NVO is a healthcare stock, of course, Ozempic drugs, and we know that those have been all the craze. And the valuation on this one, guys, is so cheap. I mean, if I pull up a Guru Focus right now, on NVO, right? Guru Focus is probably arguably one of the best websites that you can possibly find in terms of valuation. They give like 5 million metrics of valuation, multiple different valuation and discount-free cash flow models as well. You can see the Guru Focus value for this one is significantly undervalued. It has a rating of 85 on 100. The average price target here for analysts is above 100, but the valuation is supposed to be 125. You're getting a very good discount. If I can find NVO back down here, $80 to 75, it might be worth a nibble, right? Because that's the large support area overall. It's a bit extended from there now. If you have a couple declines and I can see some bids in this area, I would not be opposed to holding this very high quality company overall. And that's pretty much all of the bonus plays that I have for you guys and the top 5 options plays as well. Hopefully you enjoyed that. If you did, consider dropping a like on this video. Would appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. We do these videos every Sunday in preparation for the upcoming week. So hopefully you're able to find some trade ideas with all of those plays. And lastly, if you have any questions on the strategy, now's the time, guys. to leave them down below in the comment section, and I will gladly answer you today before the week starts. And lastly, but not least, if you guys want access to all of my wheel trades in real time, the link to the Discord is down below. Private trading Discord for myself and our members, where I not only do the wheel strategy, but also call options, long put options, call debit spreads, put credit spreads, leap calls, long-term portfolio buys, swing trades of shares, everything, not only the wheel strategy. If you want access to all of the trades, these are all of the trades since the inception of the Discord. The green check marks are win. The tiny little red circles are small losses. These are all the trades, always transparent with the wins and the losses. The link is down below. We do private live streams every Monday through Friday, 2 hours at the open where I trade live and take all your guys' questions. They're all recorded, and you can ask me all your questions in chat. Tons more in the Discord. If you want more information, the link is down below. That's it for me, guys. Have a good week in the market. Love you as always. Take care and peace.